All right, let's get right into it. The U.S. Federal Reserve just made a $40 billion move, and believe me, the ripples are being felt everywhere. In this explainer, we're going to break down a really sharp market analysis to understand what this means for stocks, the dollar, and yes, even gold. So here's the million-dollar question, right? The one on everyone's mind and at the very heart of the analysis we're digging into today. Is this the move that's going to make the markets just explode? Or is there something else going on under the surface? Let's find out. Okay, here's how we're going to tackle this. First, we'll look at what the Fed actually did with that $40 billion. Then we'll see how the markets reacted. And after that, we're going to focus in on the two assets this analysis says are the most important players right now, the US dollar and gold. So first things first, the catalyst. It all kicked off with just one single announcement from the Fed, but it was enough to immediately grab the market's attention and start a whole new wave of volatility. Now, let's get into the nitty-gritty of this $40 billion injection, because understanding what this plan is, and maybe even more importantly, what it isn't, is absolutely key to figuring out what the market's going to do next. So there it is, the big headline number, $40 billion. The Fed has started up a bond repurchase plan of this size, and their stated goal? Well, it's all about boosting liquidity in the market. And this right here is probably the most crucial distinction the analyst makes. This is not that massive quantitative easing, or QE, that we've seen in the past. Not even close. Think of it this way. QE was like an adrenaline shot straight to the heart of the economy. This $40 billion, it's more like a small energy drink, a much lighter, more targeted kind of stimulus. And when we talk about increasing liquidity, what are we really saying? Well, in simple terms, the Fed just wants to make it easier for big players to buy and sell stuff without causing a huge price swing. It's basically like adding oil to the gears of the financial machine to keep everything running smoothly. Okay, so the Fed makes its move. The next obvious question is, what did the market do? So let's take a look at the big U.S. stock indices, the Nasdaq and the S&P 500, to see how they responded. Funny enough, the first reaction was actually a dip. Both the Nasdaq and the S&P 500 pulled back a little right after the news broke. But, and this is a huge but in this analysis, the analysts' overall long-term outlook is still firmly bullish. And this quote from the original analysis just says it all. My bias remains bullish. So even with that little dip, the view is that this was just a quick flush out before the next major move up. The ultimate target is still new all-time highs. Basically, that dip was just noise, not a real change in direction. And this is where things get really interesting, because while stocks are a big deal, the analyst argues that the most important clues for what's about to happen, well, they aren't in the stock market at all. The real story, the real drama, is playing out somewhere else entirely. Which brings us to what this analysis calls the main character of this whole story, the US dollar. Seriously, what the dollar does next could end up deciding the fate of pretty much everything else. So, why is the dollar suddenly the star of the show? Well, it's just dropped into this super significant price zone, a technical area the analyst calls a monthly fair value gap. Now, without getting too nerdy, just think of this as an area on the chart that the price zoomed through so fast it left a kind of imbalance. And these areas act like magnets, often pulling the price back. The bottom line is, the dollar is in one of these zones right now, which makes this an absolutely critical make-or-break moment. And this lays out the two possibilities perfectly. So, path one, the dollar finds its footing right here and starts to rally. If that happens, it's probably going to put some pressure on stocks. Then there's path two, the dollar just can't hold on, and it breaks down even further. That could mean we're in for a much longer-term downtrend for the dollar. And all of this brings us to our final piece of the puzzle. Gold. And right now, according to this analysis, gold isn't really in control of its own destiny. It's basically just sitting in the waiting room, completely dependent on what the dollar decides to do. So yeah, the takeaway here is really simple. If you're trying to figure out where gold is going next, don't just stare at the gold chart. You need to be looking at the US dollar index. Gold is literally just waiting for the dollar to give it a signal, and then it's going to follow that lead. And you can see the connection is crystal clear. If the dollar chooses that second path and breaks down, the analysis says gold will probably continue its bull run, maybe even push for new highs. But if the dollar reverses and starts to rally, that strength is likely going to trigger a pretty sharp drop for gold. At this exact moment, they're polar opposites. So let's just tie this all together, shall we? It starts with the Fed adding a little stimulus. Stocks take a small hit but are still expected to climb higher. But the real linchpin, the pivot for this whole story, is the US dollar, which is sitting at a huge decision point. And gold is just waiting in the wings, its entire future hanging on which way the dollar breaks. And that's what it all comes down to, this final pivotal question. The dollar is standing on the edge of a cliff, and it feels like the whole market is just holding its breath. The stakes have been laid out perfectly. Now we just have to wait and see. Which way will the scales tip?